ideas, investment ideas. It doesn't, a lot of people will talk about their picks, but his research really goes in depth, really tells you the why, what catalysts are for the turnarounds that he identifies, and so on. So I think you're going to enjoy his presentation. Again, hedge fund tips with Tom Hayes. You've seen him on Fox Business. You've seen him on podcasts, not just my own, but his. And he specializes again in finding those undervalued names that have a catalyst or multiple catalysts that can help with the revaluation of really sort of the Warren Buffett approach to buying undervalued companies. So please give a very warm welcome to Tom Hayes of Great Hill Capital.
So, good morning, everyone.
Good morning.
Okay, has everyone had a great week here? A lot of value? Yeah, we really want to give a hand to Mike, to Debbie, to Kim, to Aaron, all the people that put this together, because without them, this wouldn't happen. So let's give them a hand. So, Brian Belsky talked a little bit about Jesus when he opened, and a lot of people, when they look to make the right decision, they say, what would Jesus do? I, on the other hand, when I look to make the right decision, I say, what would Warren Buffett do? Yeah. And that's my framework. Hands up who thinks Warren Buffett is the greatest investor to ever live. I agree. And what we've heard a lot this week is about a lot of stocks and a lot of opportunities that have gone up a lot already, okay? And many of those will continue to go up. There's a momentum type of investor, and there's a mean reversion type of investor. I'm in the latter camp. I like to buy opportunities when they're on sale. I say Wall Street is the only place in the world when they throw a clearance sale, everyone runs out of the store versus into the store. So we're going to talk about a few bargains. And buying bargains is not for the faint of heart. But if you do accurate analysis and in-depth analysis, you can get tremendous returns over time with patience, with low leverage, and following a sensible, repeatable framework. So, a little bit about my background, why you should listen to me or not listen to me. I've been doing this for a long time, 1.5 decades in the hedge fund business, predominantly concentrated equity longs. We do tactical shorts from time to time when we think the market is overvalued, or a sector is overvalued, or a stock is overvalued, or we just want to dampen volatility and we don't want to create tax events for our clients. Maybe you see me on Fox Business, I do CNBC International, I do Yahoo Finance, etc. And hands up who saw the movie The Big Short. Well, prior to starting my own firm, I worked for Brad Pitt, okay? In that movie, his name was Ben Rickett in the movie, Ben Hocken in real life, one of the smartest guys I've ever met. Phenomenal experience at Cornwall Capital, some of the smartest guys in the room. They focus on asymmetric bets. I can say he's not quite as handsome in person, but he's much smarter than Brad Pitt for sure. And prior to that, I was at Bedford Oak Advisors, value shop. The principal was friends with Buffett for 40 years, so I had the privilege and blessing to travel to Omaha every single year. Some years on Gabelli's private jet, which was unbelievable for a young 30-something-year-old who grew up in New Jersey carrying golf bags at the golf course in the summer, and Columbia University. So that's some background. Now, we've covered that. We've developed a reputation over time of benefiting from sector, stock, and general market dislocations and periods of distress. That's kind of our knitting. I got the nickname Turnaround Tom because of that. The people that have followed me for a long time, the people who know me in the industry, know I like to run in when people are running out of the crowded movie theater and see how many purses were left on the chairs. And those are the opportunities to take advantage of. As Mike said, we have hedgefundtips.com. We post our weekly podcast there. It's called Hedge Fund Tips with Tom Hayes, very hard to remember. It has toggled between the 1 and 2 spot in the hedge fund category for podcasts. It's been going for 5 years, 268 episodes. And what's actually happened by mistake is all of our clients have come in through listening to that podcast. And the phone calls that I get are, I've been listening to you for 3 months, I've been listening to you for 6 months, I've been listening to you for a year, I've been listening to you for 2 years, I made a ton of money off your ideas, I'm gonna send you that money to manage because I'm running a business, I'm running a real estate company, I have a career, and et cetera. So That's how we do that. And we make our money buying on weakness and selling on strength. I know that's unpopular nowadays. People like to buy things that are strong and hope that they get stronger. And that's a strategy. It's just two different types of strategies. Mean reversion is what we do. Momentum, counting on inertia is what a lot of other people do. And our confidence to step in when others are bailing is rooted in deep research and the premise that the more price becomes dislocated, the more risk has actually come out of the asset versus gone in. You know, how many people feel like when a stock is falling, oh, that's risky, I better not get in? If the framework is correct and it's a cash generative company, or God forbid, the free cash flow is actually growing before the turnaround, you're actually getting less risk as the price comes down, and you can build a position over time. Most participants see volatility as increased risk. We view it as increased opportunities. So while many people look at the 52-week high list for opportunities, we look at the 52-week low list. That's not our core place, but we always want to pay attention to what sectors are down right now. Why are they down? Do they deserve to be down? You know, there are a lot of things that are cheap for a reason, and you don't want to get caught in that trap either. And that's kind of the special sauce of doing it for so many years. You start to figure out, okay, that sector, no matter what happens, you know, a lot of the commodity stocks, no matter what happens to the commodity, they figure out how to lose money all day long. A lot of the mining stocks, et cetera. And this is kind of the ethos of our firm and our philosophy. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. So, some of you want to know where the market's going next. That's kind of not what we really do, but we did want to put a couple slides up. This shows the Dow Jones Industrial Average by year of the decade since 1897, so 120 years of data. And what we see on average is, like we saw in 2022, that was a down year. The second year of the decade tends, on average, is down, and you get some recovery in year 3 and 4, like we've seen in the last 2 years. And the middle part of the decade has a tendency to be strong. Now, if you look at this and say, oh, then I'm going to go all in, we've just had this. No, but you start to say to yourself, you look at the presidential cycle, it tends to be the midterm elections, you get a little weakness. So I think Jeff Hirsch said it well yesterday. He doesn't expect any type of material weakness until 2026. I think we probably get a little bit of a pullback after the inauguration. If past is any prologue, people are going to want to hold their stocks till through the end of the year. But earnings are good, and Belsky said double-digit earnings growth, double-digit stock markets. I think our base case for next year is somewhere between high single digits, maybe 6, 7, 8, 9% for the S&P, to potentially low double digits, 12% is our base case, which implies you'll have your 5 and 10% normal pullbacks, maybe in the early part of the year. Generally, after new president gets in, you get the rally into the inauguration, and then you get the first 4 to 6 months weak. That'll just be a time to find opportunity. Big picture here, this just shows long-term bull markets. This is a slide from Robert Slumer over at RBC, and it shows you, for the last 100 some odd years, you have 18 to 20 years of consolidation, followed by 18 to 20 years of expansion, 18 to 20 years of consolidation. If you look at the 70s, 18 to 20 years of expansion, which was 1982 to 2000, consolidation, and now we're about halfway through expansion. So most people think, well, it must be the top, it must be 2000, everyone's getting excited about Palantir, everyone's getting excited about NVIDIA, we must crash. I don't think that's the case, and if you actually overlay demographics over this, the commonality between the periods of consolidation, like 1930 to 1948, 1968 to 1982, is demographics. And right now we have very favorable demographics, as many of you know. The bulk of our population, the echo boom, is 33, 34 years old, housing formation, family formation. So we've got a lot of gas in this tank, and if Slumer's right, a lot more upside. I know Denny talks about 10,000 on the S&P. He's talking about, just based on past trends, as high as 14,000 by the early 2030s. Okay, turnaround pick. This is as boring gets. So if you get excited about Palantir, you are going to fall asleep about Cooper Standard, and here's why. They make the rubber ceiling that goes around the windows and the doors of automobiles, okay? Who's excited about that? All right, so this was a $146 stock in 2017. We started building a position for clients in May of 2022. We went public on Fox Business at around 550. And you say, okay, well, where were you in 2022? Why are you telling me about it now when the stock's up 3x, it's up 200%, about a $15 stock? Because it's been de-risked and the story is just getting started. So what was happening in 2017 is you had a sell-through in the United States of about 17.5 million cars, okay? We fell in this cycle down to 15.3 million. If you go back over the last 45 years, every cycle, peak troughs in the low 15s, every cycle peaks in the high 17s to low 18 million. Right now, we're at 15.8 million SAR. The operating leverage of this business is such that they've taken all the costs out of the business, and every few hundred thousand cars as we go from 15.8 of the bottom of the cycle to 17.5 or 18, this business can generate $3 a share in earnings, okay? When we got involved with this stock, you had something terrible called solvency risk, okay? Those are two words you generally don't want to hear when you're getting into an investment. They had to refinance about $1 billion worth of debt in fall of 2022. And legend over here, David Kotak, who's one of the best bond people in the business, an absolute legend over decades. I just had a chance to meet him. He's going to speak next. Can tell you in fall of 2020 was not the best time to refinance high yield debt. It was a scary time. The markets were closed. And we got in on the basis that they had more than enough asset coverage that they would get it done one way or another. And number one. Number two, there was a lot of private credit swirling around. So if they couldn't get it done on their own, we could find a way to get them in front of people with private credit to get it refinanced. Long story short, they got it refinanced. Goldman charged them an arm and a leg and 3, 4, 5 legs, but they got it done. Refinance risk was off the table and the stock shot up. $5, $10, it shot up to $20, now back to 15. Now, I'd love to say I'm a genius and I thought of this all by myself, but when I was asked, I asked, some people asked, what would Jesus do? I asked, what would Warren do? I also asked, what would Charlie do? And I copied this idea from Charlie Munger, who did the exact same trade in one of the cyclical auto troughs in 2001 with a little company called Tenneco, okay? Who's heard of Monroe shock absorbers, Dynamax exhaust products, etc.? And here's the beauty of what Charlie did. He read an article in Barron's about Tenneco having to refinance about $1 billion of debt, and he put $10 million into the equity. And from that $10 million, when they got refinanced and the cycle came back, he turned the $10 million into $80 million, and then he gave the $80 million to a guy named Li Lu, who started investing in China when no one was interested in China, and he turned the $80 million into $500 million. So 2 chess moves, $500 million. Who's interested in that? Okay? So was Charlie buying the things that were already up 10x, 20x, 30x, or was he buying the things that were out of favor, that had a catalyst to turn around to take advantage? The latter, right? So that's exactly what's happening right now with Cooper Standard. We've met with management multiple times. We have confidence in their abilities. They also, a lot of times when these small cap companies get into trouble, they don't respect equity. So they issue a lot of shares, they dilute the shareholders. They've actually brought the share count down while going through one of the most difficult periods in the auto industry. This is turning up. We've already troughed the operating leverage. They're now at break even. They've taken $500 million of costs out of the business. As you see, and the number one leading indicator of industry auto volume for new cars is incentives, okay? And you'll see here, incentives, first off, this chart on the top is the global light vehicle production forecast. So as you can see, this is very conservative right now because people are still pessimistic. They expect it to go back to 2017 levels by 2028. We think it's going to happen sooner. But on that basis, Cooper Standard at that peak level earned $7 a share, $7.19 a share in earnings in 2017. The stock traded at $146. We believe when we get those type of volumes, whether it's 2027 or 2028, based on how the business has been better managed, they're going to earn well more than $7 a share. They could earn $10 a share and beyond. And the only question is, what multiple is going to be applied to the stock? A trough multiple of 10 times or a peak multiple of 20 times? So we think it's got huge upside, even from $15, never mind $5. This will be a 10 to 15 bagger over time for us. So that's that. That's the incentives you can see going straight up. And if you thought that one was hairy, okay, I got one that's even hairier for you. It's called Advanced Auto Parts. You guys ever seen an Advanced Auto Parts in your neighborhood? Okay, this is the worst performing auto retailer of all three, okay? So whether you're talking about O'Reilly, et cetera, et cetera. The good news is they probably have the best CEO who's just come in. His name is Shane O'Kelly. He ran HD Supply for Home Depot. $7 billion business. He's got a military background, Harvard Business School. He knows how to run these businesses. And what he's basically done is he took solvency risk off the table recently by selling the Canadian business that was non-synergistic. He created $1.5 billion of cash for that, net 1.2, paying down debt, so he's brought the leverage ratios down to buy him time for the turnaround. And then he closed 10% of the stores on the West Coast that were all spread out. So you see that footprint of all the red dots? All of those on the East Coast is great, where in most markets they're number one or number two, and they have synergies and they have opportunity to really generate cash. They sold to Canada, paid down the balance sheet. They closed 700 stores on the West Coast that were all spread out. And now they're going to lower the distribution centers from 38 to 13. He expects to increase operating margins by 500 basis points over the next few years. What that means in English, they're going to generate $600 million in operating income. And on that basis, the last 2-3 times that they generated $600 million plus of operating income was 2018, 2019, and 2022. The stock is currently 45 bucks. In those instances when they were generating that type of operating income, the stock was $186, $182, and $240. I'm not saying that it's going to go back there, but I am saying there's an enormous opportunity. Again, operating leverage, catalyst, it's been de-risked, solvency risk has come off the table, they sold off non-core assets, same type of story. And this is how we can create doubles, triples, and stuff over a reasonable amount of time, be patient, build the position, and wait. Good things come to those who wait, right? And then finally is Etsy. Who's heard of Etsy? Okay, so you have two choices in the next 3 weeks. You can go onto Amazon, you can scattershot a bunch of chocolate baskets that's no one's ever gonna eat, unpersonalized. Your business clients, your family is gonna say, oh, yeah, you did the minimum, congratulations. You thought of me barely. Or you can go onto Etsy and get them something beautifully engraved with the most important thing to every single person with their own name on it, okay? And get a customized thing. And they've built a tremendous business in doing customized stuff. It was a COVID darling. The stock ran up to over $300 a share. It's now, we initiated at $49. I think it's still, what is it, Jeff? $49?
55.
55? Okay, so we're up on that one, barely. But here's the name of the game, ladies and gentlemen. When I talk about a framework, looking under the surface and understanding what you buy, I think about it in terms of private equity in the public markets. What would I pay for the entire business if JP Morgan was going to finance me to buy the whole company, and I had to put 100% of my net worth up for the equity of the purchase? Look at those purple bars are the free cash flow generation of Etsy. So does it look like the free cash flow has gone down a whole lot since the stock was trading at $300? Okay, so if the stock was priced, you know, Mr. Market is a manic depressive and a manic euphoric. Okay, so you're seeing a little bit of the manic euphorics a little bit this week, and some of the manic depressives in stock like this. But you know, when I look at this, if you were going to go buy 10 Jersey Mike's franchises, is that big down here in the Subway shop? And you look at the guy, you would look at the financials, by the way. I know a lot of people don't like to look at financials before they buy a stock, but if you were gonna buy a whole business, you would look at the financials, right? And if the free cash flow, the amount back to owners, back to you as the purchaser, was basically the same over the last 10 years, would you try to buy it at 20% of what it was worth a few years ago? The guy would literally call security guards and have you escorted out of the building because you were insulting and you were completely irrational. Except every day in the public markets, you get opportunities like this where if you had actually presented to the board, I'll buy the whole company at the price that it's quoted in the markets, they would call security to have you think you were a Looney Tune, but that happens every day. So stock price down 80%, free cash flow generation to owners, not only about pari passu with when it was a $300 stock, but re-accelerating growth. They're turning it around. They did make some mistakes, but they did keep 92 million users. It's the 4th most trafficked website for e-commerce site in the US. How many of you knew that? Etsy, I had no idea. I had to ask my wife, what is Etsy? Does anyone use it? And that's one of their initiatives. Loyalty programs they're initiating, downloaded apps, gifting, international, all of these initiatives. And Josh Silverman, who is the CEO, has a proven track record of winning. When he was at Skype, they increased users by 300 million in just a few years. He's got a track record of many successful companies, and he's going to do the exact same thing at Etsy through some of these initiatives. So, men, international, gifting, loyalty program, apps download, and cleaning up the curation of the website, etc. There was a period there for a couple of years where they had some counterfeit and cheap products, and that kind of turned people off. They're fixing that problem. I had an anchor ask me, like, are they doing a good job? And I said, the answer is no, the stock's down 85%. That's the bad news. The good news is they recognize the problem, they're fixing it, and we're seeing re-accelerating growth. And this is a phenomenal niche platform. The other reason I like it, it's not a Me Too platform where everyone's selling the same product and it's a race to the bottom with price and margins, which you're never going to win against Amazon, right? They don't have to have the same type of margin. Here, it's bespoke products, it's custom products, it's gifted products, it's supporting small businesses, and the runway is just getting started if you look at the total addressable market, etc. By the way, anytime you hear in an investment presentation, if you hear the word total addressable market, what they're trying to tell you is, here's why you should pay 20 times sales for this business. Run the other way. But in this case, it's trading at a meaningful discount, and they have a very small percentage of this growing and narrow group. And I have one final bonus stock turnaround Tom pick for you today. And that is, oh, by the way, my analyst Jeff put this beautiful slide together. They're generating about $600 million of free cash flow every single year. Does that sound like they have solvency risk? No. Okay, the balance sheet is delevered. The free cash flow is growing. Over the next 5 years, they're going to generate about enough cash where you can buy in 60% of the stock. They just announced a $1 billion buyback authorization. So, $1.2 billion of cash on the balance sheet, $2.3 billion long-term debt, re-accelerating growth. We like these type of opportunities. And finally is Boeing. You can't give away this stock. People are trading it like it's going out of business, except they've got a new CEO, Kelly Ortberg, who, when he was at Rockwell Collins, in 6 years, he 4x'd the company for owners. He made them 4 times their money in 6 years. This guy's an absolute winner. They've solved the issue with the unions. And by the way, they've got a $500 billion backlog. The demand for flying is going up, not down. China's going to double their fleet by 2043. And they've got a $500 billion of backlog. Imagine if your Jersey Mike's Subway franchises had 10 years worth of backlog for sandwiches, orders already in queue, already committed, already paid for, and there was no other Subway shop that they could go to if they got tired of waiting. In the case of Boeing, you got Airbus. We like duopolistic and oligopolistic businesses that have pricing power. Boeing is one of those. We see a tremendous opportunity there. And then finally, this is how to reach me. The podcast is the best way to get value from me for free. Just tune in and listen. You can get that anywhere you get podcasts. It's better on YouTube because I go through a lot of charts, data, spreadsheets, etc. Hedge Fund Tips with Tom Hayes. Twitter is @HedgeFundTips. The YouTube is the way to get me @HedgeFundTips. Email and phone number. And as always, this is opinion, not advice. We deal exclusively with ultra-high net worth individuals and family offices. So talk to your financial advisor before you do anything, and happy to take any questions.
Okay, we'll do one or two questions now, and Tom's going to be on the panel later, so if you don't get a chance to ask now, we'll definitely have some time for that. I'm standing here with the microphone. Yes.
So Amazon is what the biggest company really for consumers.
Yeah.
There's these Chinese companies coming in, Shen
Yeah.
and Temu, and
Yeah.
are there investment opportunities with those as well?
You opened up a can of worms, because if I start talking about Alibaba today, we're going to be here till 4 o'clock. Look, we've got a tremendous position in Alibaba, okay? And this has taken longer than we've expected to work, but we've had an opportunity to bring down our basis. In our view, it's the best, price is what you pay, value is what you get. We think it's the best opportunity globally. Their international business, to your point, Alibaba Express is growing at 30%. Pinduoduo is a competitor with Temu. I think Temu, if Pinduoduo, I believe their numbers are either unsustainable or unreliable, and you're seeing them get shut down in a lot of markets like Vietnam. Alibaba does quality business, and Alibaba is the toll taker in China. If you believe that the government will continue to do stimulus, if you believe that they will recover like they do every cycle, just like autos recover every cycle, and it's the cheapest covert AI play in China, because they are the #1 cloud provider, and what they do is with every AI startup, they say, don't worry about it, you don't have to give us money. We'll give you compute power, which costs us basically nothing. You give us equity. So they've got equity in every single startup, in AI startup in China, and that's given zero value right now in the stock price. You're gonna see some of these things be $1,000, and we own them indirectly as owners of Alibaba. So that's a perfect play, and it's one of our largest positions, so you're spot on.
Tom, we'll do one more here.
Yeah.
What do you think about Supermicro? Will they get their financial reporting issues taken care of, and their future, please?
Supermicro, wow. You know, that was one when it was going straight up. I said, what would Jesus do? And then I said, well, Jesus didn't give me an answer. I said, okay, what would Warren Buffett do? And Warren Buffett wouldn't touch it with a 10-foot pole, so we took a pass. As far as companies that have accounting irregularities, that is a huge red flag. Obviously, there's substance to their underlying business, but when you have that type of thing, it's a don't touch. And I live my life under a very simple framework. I am perfectly comfortable with making errors of omission. Like, I have no FOMO. FOMO is not in my DNA. Like, if I see someone make 100x on something that I wasn't participating, like, I'm super happy for them. Like, I don't think my way is the only way. I just figured out, after doing it long enough, I'm really good at one little thing, and this is what I'm good at, and I just do that. And there are tons of ways to make money. So, the short answer to your question is I don't touch companies that have a history of accounting irregularities. It's just a don't touch, because, you know, if you see a few cockroaches, you don't know how much damage is underneath the sheetrock. And for me,
you touched it at exactly the wrong moment?
What's that?
What if you touched it at exactly
Oh,
the
and
wrong moment?
you're in it. You're in it and deciding
At
what to do.
exactly the wrong moment, right before the problem.
Oh, okay, right before the problem. Sometimes you got to take your lumps. We all do. I would say two things. Number one is, if you're going to harvest a loss, if you have gains in other stocks that you're going to be paying tax on next year, you might want to harvest that loss and use that tax asset against the gains. Now's a good time to do it before the end of the year. Opinion, not advice. But if you're going to hold on to it, you better get on the conference calls and be very darn sure that you feel comfortable that the error was explainable, rational, and you feel comfortable in the financials. And then again, price is what you pay, what you get. Even though it's fallen down, what is the value of it? How much, you know, are you comfortable with the current valuation, assuming that it's correct? But for me, I run the other way from some of those guys. Yeah, I think that's it. Thank you very much.